would be lovely, probably for you as much as me, to be able to shoot one of these and not use words such as Trump, trade or tariffs. But that's proving rather difficult at the moment, so please bear with me. However, nearly a fifth of the FTSE 100's members report quarterly profits, first half results or a trading statement in the week ahead, so that should provide plenty of data and comment, while quarterly earnings season continues at full tilt in the USA. Statements which may be worthy of a look on this side of the Atlantic include the following: Associated British Foods on Tuesday the 29th, Glencore, Next, Coca-Cola, Hennick, Haleon, Segro, Barclays, Prudential and Smith & Nephew on the 30th, Lloyds and Persimmon on May Day, and Standard Chartered, NatWest and Pearson on Friday the 2nd will be the companies that round out a busy week. But for all of that list, two more names may really stand out for what they say about themselves, their industry or the wider economic outlook in the context of Trump, trade and tariffs, and their HSBC on the 29th of April and Shell on the 2nd of May. While stateside, the second quarter results from Apple on the 1st of May will always draw attention, partly because it's the world's biggest company by stock market valuation, partly because tech stocks are in some ways in the eye of the Trump trade and tariff storm because of where they manufacture or where they source vital components and materials. But to come back to the UK first of all, HSBC, well, their shares had come within a whisker of 2001's all-time high back in March, just before you-know-who said you-know-what on Liberation Day on the 2nd of April. HSBC's shares have fallen by around a sixth since then, so it'll be interesting to see if Chief Executive Georges Elhedery is as upbeat now as he was at the time of the 2024 full-year results back in February. Then, he and the board felt confident enough to sanction an increased dividend, a new $2 billion share buyback, and raise targets for return on equity in 2026 and 2027. HSBC's Asian operations generated 3/4 of group pre-tax profit last year, so analysts and investors will look for comment on the outlook here in particular. Other group-wide trends that will feed into headline profits include loan and deposit growth, net interest margins, which were 1.63% in the same period a year ago, any litigation and conduct costs, pleasingly negligible of late, and loan loss impairments, which were $720 million in the first quarter a year ago. The analyst consensus is looking for a 3% drop in group pre-tax profit for 2025 overall to $31.5 billion. So that rate of change may be some sort of yardstick for the first quarter. Do bear in mind though that in Q1 2024, pre-tax income reached $12.7 billion, helped in part by net gains on disposals of $3.7 billion. Meanwhile, the dividend a year ago was US 10 cents a share. Now, HSBC is the third biggest company by stock market capitalisation in the FTSE 100, and Shell is the second. So the oil major's first quarter results on the 2nd of May could have wider implications too. The prices of oil and natural gas have fallen sharply in the past month, thanks to worries about the impact of tariffs on global growth and thus demand for hydrocarbons. Shell share prices therefore retreated from last spring's all-time high and shed the gains made around the time of March's analyst meeting, which offered the prospect of reduced operating costs, reduced capital investment, a renewed focus on hydrocarbon production, particularly liquefied natural gas, and increased cash returns to shareholders. Nor has the share price been helped by early April's lukewarm trading update for this quarter, which flagged the impact of bad weather and maintenance in Australia upon natural gas output in particular. For the moment, analysts expect a 6% increase in full-year pre-tax income to $31.6 billion, but given trends in the oil and gas price, it seems logical to assume earnings will come in lower in the first quarter of 2025 than they did in the first 3 months of 2024. 1 year ago, pre-tax income in Q1 was $11 billion, and Shell's preferred headline adjusted earnings metric came in at $7.7 billion. As a final point, watch out for those cash returns. In the fourth quarter of last year, Shell nudged up its dividend to 35.8 US cents a quarter, and boss Wael Sawan launched a $3.5 billion share buyback for the first 3 months of this year alone. In between those two will come Apple's second quarter results on the 1st of May. As I record this, the shares are in bear market territory, down by more than a fifth from December's peak, even if that still leaves the company's market capitalization just a fraction shy of $3 trillion US. Shareholders and analysts and management are probably still all grappling with the possible implications for the cost of manufacturing Apple's gadgets and demand for them, especially given the importance of China and Asia more widely on both counts. Apple CEO Tim Cook and CFO Kevin Parekh didn't give much by way of guidance alongside the first quarter results, and analysts seem a little bit unsure as to which way to turn, as the last 60 days show 3 upgrades to earnings estimates and 3 downgrades. For the moment, the headline consensus forecasts are for sales of $93.6 billion and earnings per share of $1.60, up 3% and 5% respectively from a year ago for the second quarter. Now, in case there is any guidance for the third period, analysts looking for sales of $88.7 billion and EPS of $1.43 a share, up 3% and 2% year on year respectively. Meanwhile, the last quarter's dividend payment was 25 US cents a share, and the first quarter's buyback came to $23.6 billion to supplement that $3.9 billion cash dividend. I hope that you and your family are all keeping well. Thank you for watching, and I look forward to seeing you again next time.